Hello, everyone. Welcome to your quick market update. Inflation and mortgage rates are in the news this week. We got a PPI report, producer price index report, that looked hot on paper, but market reaction was fairly calm, largely because housing costs continue to cool. PPI measures inflation at the business level before it reaches consumers. In January, PPI was up 0.5% versus the 0.3% expected. Core PPI, which excludes food and energy, rose 0.8%, also much higher than expected. So why didn't the markets overreact? Well, earlier this month, we got CPI came in softer, and housing, the biggest piece of inflation, is still trending lower. A good real-time reading on housing inflation is rent data. Apartment List reported new rents rose only 0.2% in February, which is typical heading into the spring, but year over year, new rents are down 1.5%. They also show it's taking about 40 days to rent a unit, with a vacancy around 7.4%. Bottom line, more supply and longer lease-up times usually mean less pricing power for landlords. This matters because official housing inflation moves slowly and often lags way behind what's happening in new leases. If new rents are flat or falling now, that typically feeds into lower housing inflation later, which can support lower and lower rates over time. This is great news. Takeaway, inflation data is mixed, so mortgage rates may be a little choppy day to day, but the broader trend has been improving. And the most important component, housing cost, continues to cool, guys, and this is super exciting. For buyers, rates may not drop in a straight line, but they need to focus in on a payment that they can afford rather than trying to time the exact bottom of the lowest rates. And for sellers, buyers are payment sensitive, so pricing condition and concessions matter more than they did a couple of years ago. If you guys have any questions on any of this information, don't hesitate to reach out. Would love to chat. And thanks so much for watching, and have a great week.